Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to this podcast. My name's Justin Hand. I'm an investment banker, spent 15 years in healthcare services specifically. In today's topic, we're going to spend some time talking about what are the different options available to business owners given the heavily consolidated and continuously consolidating healthcare arena. Outlining what are the different options, what's to consider as you think about these options, and ultimately what are the pros and cons in each.
I'm AJ Shekar. I'm joining Justin Hand on this podcast, and I've been in investment banking for 6 years.
And I'm Eric Major. I've also been in investment banking for 6 years.
So many businesses in healthcare these days are being approached directly by private equity firms, strategic acquirers that are already in the sector, health systems that they have relationships with, potentially joint ventures with, and oftentimes are overwhelmed by the continuous outreach from those types of groups as well as investment banks. So in this session, we're really going to dive into what are the pros and cons of each of these each of these structures for deals, so that folks have an understanding of what's available to their organization or what they should at least consider as they think about different options.
Yeah, and I would broadly define, a couple different categories that we can, discuss in more detail. One of which is partnering with an investor. And I think, that term in and of itself obviously implies it's, some entity with capital. In our world, we're typically dealing with private equity investors, but there are also other, investors that are out there, including venture capital firms, which are focused more on early stage investment, typically, within the IT sector. You also have, angel investors, which are, typically high net worth individuals that might make investments into healthcare businesses or other companies. And then lastly, you have more family funds, which are, typically a little bit of a different strategy than private equity, where they're looking to, invest into a company and hold it for a number of years. But AJ, I don't know if you want to touch on just what we see with typically on the private equity side in terms of their strategies.
So private equity, as the name implies, invests into privately held organizations. So this is different than hedge funds who typically invest into large public companies or mutual funds that also invest into publicly held stock. These are firms that focus exclusively on investing into privately held organizations. They make their money based on investing into these organizations and growing them over time. That time period can be different group to group, and the amount of return that they're expecting can be, various as well. But they're generally taking their capital in from a few different sources. It could be college endowments, it could be pension funds, it could be large insurance companies, even private wealthy individuals, and allocating their capital into a new class of investments, which is privately held organizations, and seeking to grow those investments over time.
For our firm, and quite honestly for the bulk of the lower mid-market of healthcare, private equity has really transformed the profile of businesses that are considering and willing to do transactions. Gone are the days of people transacting because they are retiring and they had no succession plan. Private equity is influencing this market because it's giving organizations that are sound business models, business owners that are opportunistic about the organization and want to grow it, and they want to come in and augment that team of individuals and help take a business to the next level. So the profile of our client is much younger than it was a decade ago. They're business owners that love what they do. They're going to continue to work, continue to see patients if it's a physician group, or continue to grow through acquisitions or de novo expansion if that's been a part of their plan. And private equity really empowers them to actually accomplish that, while at the same time mitigating some of the risk for business owners that are inherent with owning 100% of the equity of an organization. I think one of the biggest misconceptions around private equity is that they come in and try to control the day-to-day operations of the business. In our experience, when a client of ours is a beachhead or a platform transaction, which means a private equity firm is making their first investment into that particular space, the companies that they're most excited about are the ones that are actually eager to grow, have strong management teams to support that growth, have great reputations in their marketplace, have oftentimes great clinical reputations on a national perspective through participations on boards of directors and conference boards, in forums, and really are trying to get to that next level. So private equity firm is coming in, they're acquiring some stake or a position in the business of ownership. They're empowering the original owners with maintaining equity. So our clients or the original sellers or business owners in these businesses still have equity in these organizations, and they're participating in the continued and accelerated growth of these businesses. So while there's risk in every investment, there's risk in every opportunity. Overall, the private equity model has been a very successful one, and many of our clients and many business owners out there have had a lot of success in taking their business to the next level.
Yeah, and I think to that point on risk, I think risk with private equity comes in a couple different ways. Obviously, in the case of aligning with an investor, there's going to be debt that's utilized, in order to finance and grow businesses. Given that debt is typically much less costly than equity. But on the other side of the equation with risk, I think it's clear, it's important that business owners understand that, pursuing a private equity deal is about diversifying risks that you have within the business today. If you're 100% owner of a company, without any, partners, if you're a single owner, or you have, 10, physician owners, for example, in a physician deal, a transaction is about taking some chips off the table. It's not about, selling and going and retiring. Our transactions, I would say 95% of our clients remain with the business post-closing. All of the shareholders do. And, they see these deals as a way to really diversify wealth.
Yeah, I think that's a great point, especially in kind of the uncertain environment we're seeing in healthcare today, where there's fee-for-service payments going to bundled payments, and this is really a whole segment that we could spend an entire episode on as to what is causing consolidation within healthcare. But the private equity model really, as Eric mentioned, allows for that diversification of income while still having chips on the table to grow through acquisitions and de novos, which, if you're a single shareholder in a business, or even if you're kind of a conglomerate of shareholders, it becomes difficult over time to continue personally guaranteeing the growth of your business, either by sacrificing your income from the business or taking out large amounts of debt from a bank that will still hold you personally, guaranteeing that amounts moving forward. So I'd say that the benefit is on the diversification side of things. But again, private equity isn't for every owner out there. There are certain owners who simply just want to take a step back from their day-to-day responsibilities, and private equity firms, since they're not really managing the business day-to-day, they'll look for a leadership team in place that's really primed to stay on with the business and grow that business moving forward. And size really can be a determinant of who is interested from a private equity perspective. As Eric mentioned earlier, venture capital firms typically start with smaller companies that don't have established profitability, whereas private equity firms really need to start with a company that has a track record of growth. It doesn't have to be exponential, but really kind of stable growth over time, and profitability. Justin, what would you say? Probably around, call it 2 million of EBITDA?
Mm-hmm. Or more, or greater. Absolutely. Yeah. That's very much true. I think when you think about a business, practice, organization, we even need to break out private equity into two buckets. The first bucket is a private equity firm coming in, as AJ said, typically investing in a business with at least 2 million in adjusted EBITDA, earnings before interest, taxes, depreciation, amortization expense. And the other part of that is there's a lot of private equity firms that are out there looking to grow their business through add-on acquisitions. So there are businesses sub 2 million in adjusted EBITDA that can still attract the interest of private equity, can be structured private equity in nature, but can't serve as a platform deal for a private equity firm in a new sector. What has been our experience, and I'm sure most investment banks' experience, is that low middle market, defined as sub 500 million in transaction value, private equity is really driving much of the consolidation in this industry today. About 80% of our deals are private equity structured in nature, not necessarily that 80% are platform transactions. And so with that, what we've found to be one of the biggest areas of concern for business owners is that they simply just don't understand what private equity is all about. So it's a foreign concept for them. They're trying to grapple with divesting equity. They're trying to grapple with if a deal even makes sense for their group. And here's this new foreign concept being brought into the equation that they simply have no information around. So it all ties back to how do we get groups familiar, comfortable with the model around private equity? How do we, or as an advisor, get physicians or shareholders, depending on the structure or the type of organization, to understand what the value of the appreciation and the equity, as they're still maintaining equity in this business, and what that can mean for them. And quite honestly, how can private equity serve as a diversification play for them while they still continue to be a part of this business as it grows to the next level?
Yeah, and I would say that, correct me if I'm wrong, guys, but the biggest question we always get is, what's the end game with private equity? And I think that's probably the most difficult thing for us to explain in certain industries that maybe haven't seen private equity investment for more than a couple of years, which, within healthcare, there are many at this point that are new areas of consolidation and investment. And I think that question starts with understanding the tiering that in the stratification that there is within the private equity world. Most people are familiar with the Bain Capitals and KKRs of the world. Very notable large private equity firms managing billions of dollars worth of assets. Certainly for the businesses that we're working with within the lower middle market, as Justin highlighted, we're typically working with investors and funds that are, between, $250 million to, $2-3 billion worth of assets under management. And, I think it's important to understand that there is an entire new echelon or another echelon of investors out there that, are looking at businesses with 20, 25, 30, even more, $1 million worth of adjusted EBITDA. And many of our clients are, probably 10, 15 years away from growing to, an organization of that size. So I think that's a good way to kind of understand what the exit opportunity is for these investors.
Absolutely. I'd say that the most common path we see for our clients at the end of the day is they go through one round of private equity funding from a lower middle market group. They use their capital resources to grow and scale to a point where really the lower middle market private equity group isn't willing to allocate more capital, or really is at the end of their time horizon. Sometimes it's as short as 3 years, sometimes it's as long as 7 years, where they just simply need to get a return on their invested capital for their shareholders. And it's time to go through that secondary transaction process, which more often than not becomes with another private equity group. And really, to Eric's point, there is that kind of environment amongst private equity groups where they're trading deals amongst themselves, and it gets to a point where you're either graduating to the point where you're aligning yourself with a KKR or a Bain Capital or an Ares Management, a group like that, or it's a matter of exiting to a strategic organization that exists within your relevant service vertical, or a payer or a health system, which we'll describe in a lot more detail as far as how those work as we get along with our podcast here.
Yeah, and even in IPO, I mean, that's another avenue for investors as well. Certainly, they can go public with the entity once you get to a certain size. It could make sense to do that.
Wouldn't you say, in our experience, every transaction, every private equity deal that we've done, the secondary transaction was another private equity, and that the public markets today are a little less appealing around regulation, reimbursement, and the costs associated with being public?
Yeah, I'd say that's pretty accurate. I can only recall just a handful of companies that are healthcare providers that are still public companies at the end of the day. I think it's a different scenario than, call it, in the 1980s or 1990s, where you saw some of these big practice management companies go public because their really only source of capital at that point was likely the public markets, whereas you just see so many more private equity groups who don't have the same regulatory restrictions and investor scrutiny as you see for the public companies at the end of the day.
Yeah, and when we discuss private equity, we're really focusing more on kind of platform investments, but we deal with a lot of private equity firms that are already owners within companies within certain industries, and once they make those investments, a big part of their growth strategy will be making add-on acquisitions or certainly moving into new geographies through partnerships with similar size organizations to the one they initially invested into. And that, I think, that really stems into the second category of groups that we wanted to discuss today, which are strategic buyers. So they come in many different forms. Certainly private equity-backed groups are one of the larger categories within the healthcare industry. But most people are familiar with health systems. They've talked to them in the past. They've had peers within the industry that have joined health systems, and those transactions look very different than private equity.
Yeah, I'd say that we've worked with a lot of health systems over the years, but in our experience, there tends to be some reasons why our clients have shied away from approaching healthcare systems as potential partners. A lot of our clients maybe started off their employment or their healthcare careers within a hospital system environment. And, the reason they went into private practice was to get away from some of the bureaucracy that exists within the hospital system model. I think there's also, restrictions and limitations on how they can ultimately acquire businesses due to Stark laws and things along those lines, where they can only acquire assets for a fair market value. But I think just from my experience, and you guys can chime in if you think otherwise, that's kind of some of the limiting factors we've seen as far as why health systems haven't been as active in our deals. But that being said, there's still a lot of health system consolidation going on out there.
And I think there's certain industries where health systems make a lot of sense as a partner. It could be reimbursement related. Oncology, for example, has been an industry where health systems have been very actively bringing in oncology groups, given the reimbursement benefits. And, I think in most of the areas that we're seeing private equity investment, health systems tend to be a less attractive partner when you're discussing employment and, the kind of the horror stories you hear about health systems. You sign an employment agreement. When it's up for renewal, you find out that your compensation has been adjusted, significantly.
Quite honestly, I think one of the major reasons why health systems aren't that appealing is that you are truly an employee of this system at this point. And one of the biggest motivators as to why most physicians, at least, align with private practice is that key word, private. They wanted to be owners in a business. They wanted to control the destiny of the future. And unfortunately, health systems haven't been able to adopt their model to allow for that. And so you do become a cog within the wheel. Private equity is offering a different comparable structure where physicians, at least, still remain to be equity owners in these businesses. So it's a new area, or it's a relatively new area, I should say. It's become a proven model through a lot of successful outcomes and a lot of successful second and third iterations of transactions. And so I think it's putting this health systems really on a defensive perspective, and how do they continue to attract physicians and future employees if their model's somewhat antiquated in this environment today. You couple that with not being able to be as aggressive on valuation given restrictions they have around fair market value, not always, but typically, and all of a sudden that isn't typically all that appealing to business owners or our client base.
Yeah, I think you'll see some groups become more creative in how hospital systems, I should say, in how they approach investments as they're competing with more of these private equity groups and private equity-backed organizations for acquisitions. So, for instance, HCA recently announced that they were partnering with a private equity firm, KKR, to acquire Envision, which is a big publicly traded provider of physician services and emergency medicine, radiology, and anesthesia. So there could be potential situations where health systems get more creative at the end of the day. But I think, in our experience, it's really been, some of the payors being involved in these transactions, as well as, I think, candidly, private equity-backed organizations doing the bulk of the consolidating from a strategic standpoint.
Yeah, I think creativity is kind of the key word and that we're seeing within healthcare now, because the industries are blending. Groups that were focused on one vertical, such as health insurance, are now becoming large owners of providers. United Health Group being an example. Through Optum, they've become, a conglomerate in the physician services industry, starting with really primary care groups. And it's interesting to see how, the industry has evolved from a payer perspective, and how these payers are now, potential acquirers for many of our clients. Whereas, a number of years ago, we never would have thought that, United Health Group would be the ultimate acquirer of some of these groups we're working with.
Yeah, that's a great point, Eric. I think at the end of the day, we predicted that we'd start to see the likes of Optum moving into the physician service world, the pharmacy world, but probably not to the extent that we saw and as quickly as we saw. I think that's taken the market and business owners a bit by surprise that now all of a sudden this is an option for their organization. And so as you start to think about what does a strategic acquirer look like and how can they benefit me as a business owner, you have to complement that, or you have to contrast that to what can someone in the private equity side of the world offer me versus what does a strategic acquirer offer me? So things around, the benefits from a cost perspective, strategic acquirers can offer that in a different way than private equity firms can. Around redundancies and costs from patient control and from managing costs on behalf of the system. That's a big part of why Optum is driving or pursuing a lot of the acquisitions that they're currently in their pipeline. And we can speak from some level of experience in the last couple of years having closed transactions, but it's less around what is the economic value of the business they're acquiring as what is the economic value of being able to in some way control the patients and the costs associated with that patient population.
Yeah, and strategics offer scale, and with scale comes, the ability to negotiate. I think that's an important point because, certainly aligning with the private equity firm, they're not necessarily bringing in that scale, they're building towards it. But if you do align with a, private equity-backed group or another strategic entity, you immediately get the benefits of scale, which, when you look at from a cost perspective, as we touched on, obviously there's cost savings when organizations combine. There's also leverage with vendors. There's lenders with leverage with payors as well from a negotiating standpoint. So having that size and scale provides benefits to a business. I mean, it's economics 101, and I think the benefit of aligning with a strategic entity is you get those cost savings immediately.
Yeah, I'd say that those are all great points and really a catalyst for why we've seen so many strategic deals done over the last few years. I'd say one of the, kind of taking the other side of the table, you see a lot of groups hesitant to align with the strategic organization because they feel there's a loss of autonomy in aligning with an organization that is much larger and may not need kind of your direction on the business or the business that you're merging into their organization moving forward. And to your earlier point, Eric, flexibility here is key. And what we've seen in the market is that groups have tried to solve for that perceived loss of autonomy through potential rolled equity into the larger organization. So instead of taking 100% of your transaction proceeds in cash at close, you're actually using some portion of that to buy stock in the parent company. And that really aligns interest in terms of everybody across the board having the incentive to grow the equity value of this business and really keeping their eye on growth, keeping their eye on efficiency. And for the providers, especially where we see so many transactions in physician services, where there are multiple providers that are also revenue generators and shareholders in these businesses, that equity helps keep them incentivized to keep seeing patients and growing their business by the clinical side of things.
I think that's probably the most common thing you'll see across any potential structure, any potential group that you potentially transact with or ultimately transact with is how do we align those interests to ensure consistency of a business model, growth in the business model, to the extent that it's a physician group, maintain the productivity levels of the physicians in a similar fashion post-transaction as pre-transaction. And what we've found over the last few years, and much of this is driven by competition in the industry, is that these groups are having to be more flexible, but they're willing to be more flexible because ultimately it's better long-term value for all shareholders. And hopefully, I think it's the intention of every acquirer out there. It's also in the long-term benefit of all the patients in the community in which those organizations are servicing, and that ultimately is rooted in why transactions are happening and going to continue to happen in the industry.
Yeah, what's interesting when it comes to strategics, not to get off topic, but I think groups we'll probably have the question of, from a valuation perspective, how does that compare with a private equity firm? And years ago, I think we would answer that saying, typically strategic entities, given the fact that there's some cost savings they can bring, maybe some revenue opportunities, typically are more competitive on valuation and, have other levers they can pull, through the deal. But I would say that that's probably changed in the last, couple of years in terms of, private equity firms being more competitive. What do you think, Justin?
Yeah, I think if you were to think about the four categories that we talked about, private equity, strategic, payers, and health systems so far, I'd probably put health systems in a different bucket. They're still restricted in most instances around how aggressive they can be on pricing, and that's unfortunately just their limitations. But I think the other three categories, in certain instances, can surprise us. There are situations where we've been surprised that private equity firms have significantly outbid strategic acquirers, and we thought that would have been a logical defensive move for a particular private equity firm, for a particular strategic acquirer. There's been instances where payers have significantly outbid private equity firms. But I think, to your point, Eric, at the root of all of the valuation trends that we're seeing, it's rooted in private equity. They are driving they are driving the valuations to the heights that they are, and they're forcing these other groups to be much more flexible around their structures, because now private equity is offering the opportunity to be equity in these businesses post-close, different from how it was 10 or 15 years ago.
Yeah, to Justin's point, just putting some statistics behind the healthcare services investment activity that's happened over the last few years. In 2014, there was about $37 billion of capital invested into healthcare services by private equity firms, whereas the full year 2017, it actually went up to $109 billion in capital invested into healthcare. So just speaking to the sheer increase in investment activity over time, it's certainly been very apparent to us over the last few years. It's difficult for us to say that investment activity will happen at such a rapid upward pace, but certainly something that we are keeping our eyes on for the short term. Yeah, just to put some statistics behind Justin's last statement, we've seen private equity investment in healthcare increase from about $37 billion of capital invested in 2014 to about $109 billion of capital invested in 2017. So it certainly speaks to the sheer volume of activity driven by private equity within the last few years in healthcare services. And while we don't think it's going to increase at such a rapid rate over the next several years, it's certainly indicative of the interest we're seeing today.
As AJ said, the significant increase in total allocation of private equity dollars in healthcare services, a mix of that is platform deals where funds are making their first investment into healthcare. But then the second part of that, or another big part of that, is with fundraising eclipsing the prior year on a regular basis the last few years, we're expecting that add-on acquisitions will continue to be a big driver of consolidation across all healthcare services. So it's an incredibly interesting time for business owners, where it's not just an alignment with the health system if you're a physician group. It's not just a deal with a strategic acquirer if you're a home care or post-acute provider. It's not just selling to a large-scale manufacturer distributor if you're on that side. Now you have a real wealth of opportunities that are available to your groups, and much of that, as I commented a few minutes ago, is driven by just the aggregate interest from the private equity community at large. As you can see, there's a tremendous amount of options available for business owners. I think one of the challenges that we have as an investment bank across all healthcare is there aren't very many particular examples that we can give for each, where business owners in different subsets can actually draw parallels. So in future podcasts, we'll speak to specifics, industries or industry verticals that will talk to how private equity is investing into sector ABC, how strategic acquirers are investing into sector 1, 2, 3. So you can actually have a better understanding how it's relevant to your space. But with that, thank you for joining. My name's Justin Hand.
I'm AJ Shekar.
And I'm Eric Major. Thank you all for joining.